All right, recording started, so we are set. So till others join, let me start with question and answer sessions. Short put and long put. Long put is a bearish, right? A bearish strategy. What does a put give you? Put gives you the right to sell. Absolutely correct, Shiva. So when put gives you right to sell, that is long put is going to give you right to sell. So the opposite is going to be for the short put. So what is a short put characteristic? If long put is bearish or bullish? Perfect, Rajnish. Obligation to buy. Short put is going to be obligation to buy. Long is buy and short is sell for options. Correct, Chandrasekhar. What is confusing terminology, Pudupet? We don't look at options chart. Arun Joshi, did I show you options chart before any time in the last 2 days? All right, Deepa, you can complete the quiz during lunchtime. Not a problem. November call or November put, but it does not denote buy or sell. So you're talking about the quiz, right, Ramesh sir? How does that matter? Buying or selling is your action, but the put's characteristics won't change, right? Something that has a basic characteristics, it won't change even if you buy or sell. शॉर्ट पुट क्रेडिट ट्रेड है जिसमें रिस्क अनलिमिटेड है. स्क्रिप्ट करते हो क्या? या दैट्स फाइन प्रसन्ना. तो शॉर्ट जब करते हो उसमें आपको अनलिमिटेड रिस्क नहीं है. हाय, पुट इज शॉर्ट मींस व्हाट? हाँ, तो ऑप्शंस में स्टॉप लॉस यूज नहीं कर सकते क्या? Who told you we cannot use stop loss in options? That's it. So first of all, if you want to become a trader, right, you stop thinking like this, Abrar. You can't think इसमें unlimited risk है. Trading is risk, and our job as traders is to manage risk, and nothing better than options to manage risk. And आज तक मैंने options में जितने भी पैसे कमाए अबरार, सब credit strategies में ही कमाए, बेच के कमाए. Vijay, which script were you trying to check? Pudupet, what do you mean by it should be, because Bajaj Pen is optionable. If you're trying futures, it won't work. You have to look at spot chart. Remember, the IV tool only works on the spot chart. Pudupet, you say put is short, and if we say short a put, it says long. What do you mean? Who told you put is short? Put denotes a bearish activity. Okay, put means long put is short script. Long put is similar to short script. So if you short a put, it will become long the script. All right. Okay, perfect. Rahul says on page 14, D2, why they have quoted OTM example, buy script at 49 and buy 50 call. Is this the quiz you're talking about, Rahul, or the slides? All right. Break-even points. I'll talk about break-even points because even sir wants that. Slides, page 14. All right. Just hold on, guys. Now don't type your question because there are too many questions I'm yet to answer. This one. This is comparing two different things. This is buying the script at 49 and this the dotted line graph. The dotted line graph is the long script and this red and green line is the buy call graph. Rahul, clear? This graph has two graphs. It's just for illustration purpose. Prasanna says if you long a 40 call for 50, how can you long a 40 call for 50? How can you long a 40 call for 50? 50 paise or 50 rupees? Day 2 or day 3? If you long a 40 call for rupees 10, you have the right. Hey, simple question, yaar, Prasanna. This question, right? If you long a 40 call for rupees 10, can you guys hear me? The voice is okay, I guess. Okay. Now, Prasanna, what does a 40 call give you? Right to buy or right to sell? Right to buy. Right to buy at what price? That's it. That is the answer. See, in most of these quizzes, right, extra information is provided to you to confuse you. When IV is in zone 5 and above, we prefer selling option because the prices are inflated. Correct, Anand? So question quiz 16, 18, 20. 16 is this one, Ramesh ji. A long option position has dash risk and reward. When you buy options, what is your risk? Limited or unlimited, Ramesh ji? limited risk and unlimited reward. That's the answer, Rameshji. Got it? A long option position, it doesn't matter if it is a call or a put. A long option means you're paying premium. You're paying premium. This one. Yeah. So determine whether the following options are in the money, at the money, or out of the money. This is the current market price. Do you see? It's around 25.91. So in this option chain, which is the closest to 25.91? So November 20 and 25.91. Does November 20 call give you any benefit when the price is trading at approximately 26? Do you have any advantage of November 20 call? Hiral, I have not yet spoken about delta. So that is something that is not yet done. November 20 call, does it give you an advantage when the current market price is 25.91? Yes. So then is it, if it gives you an advantage, does it have intrinsic value? Yeah, I know, because yesterday we did not cover delta. That's okay, Hiral. So is it in the money or out of the money, Rameshji? Because it provides you an advantage. That's it. In the money. So probably you missed this part, right? Looking at the current market price. Because without this, you won't be able to answer these questions. So now you can answer the remaining ones, right? Okay, perfect. 18. Determine the break-even points for the following options. Table questions. Which one, Dhirendra ji? What's the formula for break-even for call option? Strike price plus premium. So 50 call and 5 means what? Yeah, serial number, forget it, sir. Because that's online quiz. This is a on location quiz. So break even is 55. Absolutely right, Rajit. Got the point? See, for calls, the break even is always going to be strike price plus premium. For puts, the break even is always going to be strike price minus premium. That's a basic formula. Irrespective whether you're buying the call or selling the call or buying the put or selling the put. That does not matter. Dhirendra ji, which are your tabular questions? So what about September 100 put at 5 rupees? What is the break even point going to be? 95. Perfect. Now everybody got this? Uh, Dhirendra ji, you had issues about break even point. Did you get this? Alright. Tabular, is it day 3 or day 2 quiz, Dhirendra ji? So the profit and loss graph, we'll do it later on, not now. Day 2. Tell me the question. Which can you read the question for me, Dhirendra ji, or just tell me what question is that regarding? Arey, today is day 3, but the quiz for day 3 is based on day 2. The graph you're talking about, Ramesh, the graph I'm going to do it later on. Let me first finish with all other questions. Determine the intrinsic value and time value for the following options. The stock is currently trading at rupees 43. The call is trading at 1 rupee. 50 call. What does a 50 call give you, Rameshji? Right to buy or right to sell? Right to buy. At what price? Hey, 50. One is the premium. 50 is the right to buy. The right to buy is at 50 rupees, not at the strike price. 1 rupee is the premium, remember. To own the right, you have to pay 1 rupee. Okay. So, would you prefer to buy at 50 rupees or would you prefer to buy at 43 rupees? What is logical? Rameshji, if I give you a choice, you can buy either at 50 or you can buy either at 43. What would you choose? Forty-three. Perfect, right? Lower. So that means there is no advantage of this call option that you own. Correct? You don't have any advantage of the call option. The call option advantage will only be if the current market price is trading above the strike price, isn't it? Then you have an advantage of holding that call because that call will give you the right to buy at a lower price. Answer, Prasanna, Ramesh ji. Yes. So that means there is no intrinsic value. So intrinsic value is 0. So whatever is the remainder in the premium is going to be your time value. So intrinsic is 0, time is 1. Yes. So 45 also the same thing. It is out of the money. No intrinsic value. And 7 rupees is your time value component. धीरेन्द्र जी क्वेश्चन नंबर बताइए. The 55 put is in the money, the 40 put is out of the money. So, Ramesh ji, what is the 55 puts intrinsic value here? Yes, you should be able to. Perfect, Ramesh ji. 12 and 1. That's it. You got it. Arun, not 8. How can it be 8? 55 minus 13 is the intrinsic value. That is 12. So always think from advantage perspective. Whether do I have any advantage of owning that call option or no? So you tell me 40 put gives you the right to sell at 40 rupees. So would you want to sell at 40 or 43? Perfect put it. 43, right? That means 40 put is out of the money. So no intrinsic value, and whatever is the premium is your time value component. How can HV be in zone 1, Prasanna, when stock entered? HV is not never in zone 1 or 2. HV defines the zones. It is IB which can be in zone 1, 2, 3, 4, and 5. Your question is incorrect. Ramesh says here one problem. Call is buy for sell. What is call is buy for sell call? How? I did not get your question. So high IV never allows you to buy options. High IV means you should always sell options. For call 50, less than 43 buy call. You won't buy the call, right? There is no advantage. If you have sold a 50 call, then it is going to help you. If you had sold the 50 call, you would be in profit. Yes. If you had bought the 50 call, you would be in loss. Anyone? धीरेन्द्र जी आप क्वेश्चन नहीं बताया आपका. What about the rest? Any questions? Similar questions to this? Okay, let me see if I can open them. Hmm. Yes, Anand, you're right. Is it day 2 or day 3, Dhirendra ji? Do you know the slide number? Any chance? Is it this one or this one or this one or this one? Are you there, Dhirendra ji? I'm waiting for your answer. Where did Dhirendra ji disappear? Question 1. This one? Ramesh ji? How come you don't answer fast here? You have to tell me, right? Which one is that? Same one again. Now you showed. This is like this one. Dhirendra ji, is it this one? Determine the break-even points of the following options at expiry. December 50 call at 5. What is the break-even formula for a call option? What is the break-even point for a call option? Strike price plus premium. So 55 is the answer. Correct. 40 call at 4, 44. 85 call at 7, 92. 100 put at 5, 95. 45 put at 8, 37. 20 put at 3, 17. Got it? So for puts it is strike price minus premium. For calls it is strike price plus premium. This one? Yeah, so now tell me, this is the same thing that we discussed. It was the same question that we discussed right now. So 50 call is trading at 1 and the stock is trading at 43. Would you, so what does 50 call give you? Right to buy or right to sell? Hey, right to buy, call option. Dhirendra ji, I am expecting these answers from you because I am repeating it for you. So if you don't answer, I will stop it. Right to buy. Would you prefer to buy at 50 or would you prefer to buy at 43? Forty-three, right? So that means the call has no advantage for you, isn't it? So if the call has no advantage, is it going to be in the money or out of the money? Out of the money, absolutely correct. So now got this. Now December 55 put gives you right to buy or right to sell. Right to sell. So would you prefer to sell at 55 or would you prefer to sell at 43? 55. So that means you have an advantage, right? Dhirendra ji, do you have an advantage of owning that right? That means it is in the money. In the money by how much? 55. The strike price minus premium is going to give you the intrinsic value 12. Absolutely correct. And then the remainder is your time value. Got it now? No problem, Vasudev. This one, Ramesh ji, this one. This one. Okay, let me show it to you on tabular. This one. Ramesh ji, what is the question? At least tell me, na? This is before. This is before. Starting. There is no table in the starting. Yeah, what is the topic? At least you tell me that. Or look at these. Look at these and tell me which one is your question. Tabular is only this one. Till your answer mark. Sir, long December put at 4. Hey, this one you're talking about. Long December 50 put at 4. Let me check in this. Long December 50 put at 4, 50 put at 4, 50. This one? Kabhi long, kabhi no. Day 3 or day 2 quiz? Ramesh ji. Arey sir. Okay. I don't know which question you're talking about. Long. What is the question about? What do you have to find in that question? At least tell me that, then I will be able to locate the question. Long December 50 put means what? And I showed you whatever long December 50 puts were there. Guys, if you have to ask me questions regarding the quiz, right, you have to either know the slide number or you should know the questions correctly. Okay, Rameshji, you check your question and then later on after lunch we'll answer that. Okay? We'll do that after lunch, don't worry. No problem. Just find out the question. It is 27 December. This one? Standard, Girish. It is standard. Chandra, not today. पहले सीख तो लो ऑप्शंस कैसे होते हैं बाद में then you can think about all these things. Why are you in a hurry to understand how this works? This is incorrect thinking from you. Since you do not know anything about options still, you are wanting to know a practical scenario. Do you think I'm not going to take you into a practical scenario? I also showed you yesterday all the Excel sheets. What yesterday's scenario? Yeah, so forget yesterday's scenario in the market. Why are you bothered about what the market is doing? Are you here to learn or are you here to look at the markets? Any other question? Otherwise, we'll take a quick break. And then at 9:30 start with Delta. Anybody has any more questions? No? So should we take a quick 15 minutes break and come back? Okay, Anand, go ahead. I'm just waiting for Anand's question, guys. Does anybody else have any question? Yes, Anand. All right. Should we take a quick break now? You can manage your positions. We'll come back and then start with delta. All right. Done. Expectation. Correct. When people's expectation change, measure how parameters. All right. Let's go ahead. Fine. So let's go with uh, the Greeks. All right. So this is another important topic. Now, if you are able to understand Greeks correctly, right, then the theory part is going to be over after Greeks, and the strategies will be extremely simple. If you understand the purpose of Greeks and what they offer to us. All right. The purpose of using Greeks with options. Greeks allows us to measure how parameters. Now, are our options, when we get into an options trade, are they exposed to different risks? Okay. So Greeks allow us to measure how these parameters such as script movement. We know script movement has an effect on the options premium. Time passage has an effect on the options premium. Volatility changes has an effect on the options premium. And interest rate changes also has an effect on options premium. So Greeks will tell us how these factors will affect our options premium. Understood? The purpose of Greeks? So there are many parameters, but these are the main parameters. Script movement, underlying moving, how is it going to affect my option? Time is passing, how is it going to affect my option? Volatility is changing. Volatility is nothing but what? Expectation, correct. When people's expectation change, how is it going to affect my options premium? And interest rate changes. How these affect the value of an option? They give us a greater and a deeper understanding of the options risk and behavior. Greeks give us a greater and deeper understanding of options behavior. They make our life easier and are calculated by using theoretical options pricing model. So how do we get the values of these Greeks and the value of implied volatility? So basically, there is a mathematical model called as Black and Scholes model, okay, which accepts parameters like whether it's a call or a put, current market price, time to expiry, risk-free interest rate, All these information it takes in, and the output is what is the implied volatility and what are the other parameters like the Greek parameters. Okay, we do not have to understand how a Black-Scholes model works, because it's I mean, imagine those two gentlemen, Black-Scholes, got Nobel Prize for that. So if you want to understand, if you really understand the whole Black-Scholes, probably you can stake your claim for Nobel Prize. Alright, they are used to fine-tune constructed trade positions in order to execute smart options trades. Okay, they are used to fine-tune constructed trade positions in order to execute smart options trade. Now these are the grip. कॉपी नहीं करने का ना, उसके बाद कुछ ना कुछ 19-20 कर देने का, खत्म हो गया. Yes, yes, there is sound, Sony. Just that I wasn't speaking. Why will log out? Okay, you don't have sound. But then how did you say okay? That means you heard me. Okay, she read your thing. Okay. All right. So these are the Greeks that we are going to understand. Delta. What is delta? Delta tells you the impact of script movement on the underlying, on the options premium. So if the underlying moves up or down, what is going to be the effect on my options premium? You want to know, right? If the underlying moves up by 1 rupee, what is going to be my new value of option? Would you want to know that or no? That is told by delta. So delta tells you if the underlying goes up, what is going to be the new value of my option? By how much it is going to change. That is what delta tells us. Theta tells us if 1 day passes, what is going to be the effect on my options premium because of 1 day passing. Remember, options are what are options? Derivatives, and they are wasting asset, right? They will lose value over time, isn't it? So what is the value that they will lose over time is what is denoted by theta. Make sense? Easy or difficult? Are Greeks really Greeks? Yeah, only business days. No holiday. But holidays also will affect your theta, right? And the third one is Vega. Vega tells you the impact of implied volatility changing. So when people's expectation change, is it going to affect the options premium? So Vega will tell you what is going to be the impact of changes in people's expectation on the options premium. That's it. All right. Yeah, clear. So the first three are the most important Greeks. The other two are okay types, and they don't affect us so much in our options trading. But the first three are the main ones. Your job is to understand the first three ones correctly, because that will make your life easier as an options trader. Gamma tells you the rate of change of delta. Now we know that delta is not delta also keeps you don't know, actually you'll come to know that delta is not constant. It keeps on changing as the underlying keeps on moving up and down. And who changes this delta? It is gamma. So gamma will tell you the rate of change of delta, and rho will tell you what if there is a change in interest rate when you are in an options trade, how is it going to affect your options premium. All right. So simple. Delta tells you the impact of the script price movement on the underlying. Theta tells you the impact of time passing on the options premium. Vega tells you the impact of people's expectation changing or implied volatility changing on the options premium. Gamma is the rate of change of delta, and rho is the impact of interest rate on the underlying. Any questions on the basics? Okay. Now let's start with delta. We'll just start with delta. We have 15 more minutes, and we'll cover few slides and then come back again. Absolutely. People think options are difficult. It is not difficult. It's just that you are new to it. Once you understand it, it is pretty simple and straightforward. Focusing on delta. What does delta tell us? Delta measures the change in the options premium given a 1 point change in the price of the underlying. Correct, Rahul. So if your underlying goes up by 1 rupee, what should be your new value of call option? If your underlying goes down by 1 rupee, what should be your new value of put option? If your underlying does not change, what is the impact? Or it moves 10 rupees, 15 rupees, whatever it is. So they are going to have an impact on the this. As per experience, these values are practically give result. What do you mean practically give result, Anand? Yeah, they're real figures. They are real figures. Okay, a call is positively correlated to the script price. So as the price of the underlying rises, the call's premium will rise. As the price of the underlying falls, the call's premium will also fall. Is that correct? I mean, do you have any doubts on this statement? Positive correlation. Remember your palms. Left goes up, right will go up. Left comes down, right will come down. Now, calls have positive deltas. Why positive deltas? Because they are positively correlated to the underlying. Simple. Calls are positively correlated to the underlying price movement. That's why calls will have positive deltas that will range from 0 to +1. Far out of the money call options will have deltas approaching 0. At the money call options have deltas of approximately plus 0.5, and far in the money calls have deltas approaching +1. So these are the standard values for the options. Call option, the standard delta values for any delta value for a call option can never exceed 1 rupee and can never go below 0 rupees. Okay, so the boundary is defined by out of the money and in the money, and the at the money strike is the center strike. So at the money strike center will have a delta of 0.5. In the deeper in the money will have deltas approaching +1. and deeper out of the money we'll have deltas approaching 0. Is that clear, everyone? Ramesh ji, any doubts? Okay. Now this is how the graph of a 50 call option would look like. Okay. So these are your stock prices. These are your delta values. And let's say we are talking about a 50 call. What is about FAR options, Anand? Any option this is. Doesn't matter FAR or close. What do you mean by FAR options? Anand, what do you mean by FAR options? Yeah, far out of the money means it's distance from the current market price, not expiry wise, price wise. So if Nifty is currently trading at 10,700, isn't 11,000 going to be far out of the money call option? Or 11,500? It is going to be far out of the money. 10,000 is going to be far. No, 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 no. Far out of the money. Where is expiry written here? Now, script trading at rupees 50. The stock is trading at 50 and we are talking about 50 call option. So, is 50 call option going to be in the money or at the money or out of the money when the script is trading at 50 rupees? At the money, of course. So, at the money, we'll have deltas approaching approximately 0.5. Okay, so this is the at the money. And when the stock price is trading at 100, is your 50 call in the money or out of the money? Out of the in the money. Who said out of the money? The stock is trading at 50 and we are still talking about the 50 call option. How can that be out of the money? It is in the money. So in the money will give you deltas approaching +1. And when the stock is approaching 20, 10, 0, is 50 call going to be in the money or out of the money? Out of the money. So delta will be approaching 0. So the graph is not linear, as you can see here. Is this graph clear? This is just illustration. You have to just, and this is the theory is only for understanding what delta provides us. None of this is going to be used in the day-to-day thing. The only thing we are going to look at values and decipher the meaning from those values. That's it. Yeah, maybe. Okay. No, 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 no. Delta will all see. Delta will become +1 as it becomes deeper in the money. So when the stock is trading at 60, is 50 going to be deep in the money? Or 50 is going to be deep in the money when the stock is trading at 100? Delta is one of the things which decides the premium, which changes the premium. Delta does not decide the premium, please remember. The premium decision is based on how fast the underlying keeps on moving. Yeah, so 60 is going to be in the money, and at a price of 60, delta will necessarily not be 1. But yes, Deepa, delta will be 1 for when the price is at 60 only at expiry. Because at expiry, time value becomes 0 and delta becomes full plus 1 if it is in the money. Even if it is in the money by 5 paise, it will become 1. The 10 call option, Omkar. Yes, Suresh. It is same for all scripts. It will be out of the money, right? If here far in the money would be 10, how can 10 be in the money? 10 will be out of the money. You're talking about 50 call option. I did not. What, when is it? It is 1. As it becomes deeper in the money, it becomes 1, and it is 1 only at expiry. Remember, if you have 3 days to expiry and the stock is trading at 100, the 50 call option will still be 0.99 probably. The exact figure of 1 is only when it is at expiry, and that doesn't matter to us. Umkar, I didn't get your question. It is going to be deep in the money, correct? Because you wrote 10. Just give me a moment, guys. Underlying rises, the puts premium will fall. Okay, all right. Now, a put is negatively correlated to the script price. We know that as the underlying goes up, your puts will go down. Movement per rupee. Anthony, it is a movement per rupee, not per day. If in a day it moves 50 rupees, your option will also move appropriately. We are talking about direct stock movement, not time. Time theta comes into play. Puts have negative put is negatively correlated to the script price. As the price of the underlying falls, the put goes up. As the price of the underlying rises, the puts premium will fall. Puts have negative deltas ranging from -1 to 0. Now remember one thing: the negative sign. All of you pay attention. The negative sign is because of the correlation. Negative correlation. Got it? The negative sign is because of the negative correlation. So far in the money, puts have deltas approaching -1. At the money, puts have deltas approaching -0.5. Far out of the money, puts will have deltas approaching 0. And this is how the graph will look like. As the underlying starts dropping, the put delta will approach -1. As the underlying starts rising, your put deltas will approach 0. And at the money, put deltas have a value of 0.5. Correct. Okay, so we will start with these slides after breakfast break. All right. Any questions so far till this? Yeah, all of you have to log out now and log back in at 10 o'clock. No questions? Yeah, log back at 10:30. Nothing, it's just the opposite, Deepa, of put. Put is negatively correlated to the script price. That's why puts will have deltas ranging from -1 to 0. Calls have deltas ranging from 0 to +1. Puts will have deltas ranging from -1 to 0. Far in the money puts will have deltas of -1. In case of calls, far in the money puts have deltas of +1, right? At the money puts have deltas of approximately -0.5, and far out of the money puts have deltas approaching 0. There's nothing different. This is how the opposite graph. Yes, Chandra. What do you want? The first graph. Go ahead, Chandra, fast. Yes. Premium, see, premium does not only get affected by the underlying price movements, Venkatesh. There are many other factors, right? So if everything is constant, like today, let's say Nifty stays at 10,671 till the expiry, nothing changes. Nothing changes, then only the intrinsic value can remain, because time value is going to go and become zero at expiry. Chandra, this is there in your manual. All right, fine. So let's meet again at 10:35 now. 30 minutes more, and we will continue with Delta. So my intention is to finish the Greeks by lunch. If we are able to finish Greeks by lunch we will be on track, and last day we can have many examples to be done. But remember, it is beyond my control. If since it's a bigger class, if you are unable to yeah, if you're unable to complete everything today, then it's going to eat into our practice time. Then you'll have to do practice at home. All right. So limit your questions. Pay attention to what I'm teaching. Don't try to just ask questions and think that your questions will I will get impressed by your questions. I will only get impressed by questions if they are smarter and if you are asking me something that is not told to you. So you pay attention. If you're not understood, then you ask questions related to the topic. And once you understand, we move ahead. Okay, let's come back in half an hour. All of you, please log off.